Hey, Brian here. It is Friday, the 24th of March, 2017. Hope you had a good week of trading. The markets did lose some ground here, except for the semiconductors, which remain quite resilient here. But let's take a look at the action on the charts and make some sense of it and see where we're going from here. We broke below the 5-day moving average last Friday, and that put us in cautious mode coming into the market this week. We then broke below this level of support at the 235.75 to 236 level. And when that happened, it really confirmed that the sellers were serious this week. And in order for the market to get back to neutral for next week, we're going to need it back above 236. And then for positive, we'd like to see it kind of, spend some time here and then the buyers regain control. Otherwise, we still look at this market going into next week as guilty till proven innocent because it's below the declining 5-day moving average. On a daily time frame, you can see that we came down within pennies of that 50-day moving average as well. Today's low was just 6 pennies above that 50-day moving average, and of course that trend line that I've drawn in there, which represents the essence of trends since December. Now, if we're to fail here, well, then a couple other levels to keep an eye on would be the volume weighted average price from the beginning of the year. Certainly, it would be, I think, bullish for us to come down and maybe scare some people below the 50-day moving average and then go on to recover. But until that happens, it's just a scenario, and if the market does continue lower, then the next bigger important level of potential support, I think, will be found at the volume weighted average price from the election, which we're still well above. So as far as people saying, the Trump rally is over, the average price from the election is right about 227 and a half. So we've still got a lot of good feeling in this market based on the average price that the S&P 500 is closed at. So to reiterate, going into next week, we're guilty till proven innocent below this declining 5-day moving average. Back above this level makes us more neutral. The NASDAQ, as we said, lost a little bit of ground this week as well, but still holding up much better on a relative basis. It is closing, though, below the 20-day moving average. We had that big move lower on Tuesday, of course, and really haven't been able to regain that. In fact, if we take a look at, here's the volume weighted average price from that event, we closed pretty much just above it and also below the declining 5-day moving average. So this is a market really that is sending us mixed messages here, that we're below the declining 5-day moving average, which tells me innocent till or guilty till proven innocent, and we need it back above 130, 130-ish to become neutral again. But the bigger potential support down at 129.50. Another way to look at this big move from Tuesday would be Fibonacci, and you can see that a 61.8% retracement is pretty close to where we got today. So that tells us that will remain an important level, and that we just have to go a little bit more slowly, I think, until next week we will get some kind of resolution in either direction. Russell 2000 has been the real laggard, and this week what we saw was a quick undercut of the prior low for the year. And as that happened, like we often see when we have a slight undercut of a level, when that happens, we often see that short sellers get who are late get involved there, and that the stops from that prior low get hit, and it often turns out to be a terrible place to sell because the people who sold there didn't ask where had it just come from, and the market used a lot of energy getting down to that level. We've been keeping track, of course, of the volume weighted average price since the election in here as well, and on a closing basis we are holding above that, although we've kind of chopped back and forth above and below it a little bit the last few days. So let's look at some action on the short. Well, actually, let's stay on this daily time frame, because next week, if it breaks below this level, then what we would have is a declining 10 and 20-day moving average, a 50-day moving average that is flattening. And if we make a lower low below that, then I think that things could get worse. I'm not calling for that, and it's not about being in the prediction business. It's about being in the anticipation and risk management, getting back above 136, gets us more neutral. We can breathe a little bit easier, but we still have problems with this daily chart being below the 10, 20, and 50-day moving average. So I think the best case for the Russell 2000 is it can start to get more neutral. But right now, I think it's a better market to just kind of stay away from. And if you're an active day trader, this is a great market. If you're an investor, there's a lot of volatility. The semiconductors came down to their rising 20-day moving average in the trend line since the beginning of the year that represents the essence of this trend. We came down to just above that and held the key level at 77.5. So 77.5 is a very important intermediate term level. We did close off the highs here today, but still up on the day, and of course up for the week as well. We came up to the prior peak here today and then fell off, but we're still above that 5-day moving average and just showing a lot of volatility in here. So let's take a look at a 15-minute time frame. And for the week, you can see that the volume weighted average price in here, we're above that as well. So the key level is down at about 77.50 to 77.75. As long as we remain above that, any trades you should be doing on the short side should be very short term. And you wouldn't want to just short it. Let's say it dropped down to here Monday morning. It would be foolish to short it there unless we had a bounce and then it started to roll over, and you would maybe want to short it, let's say right here. That way you could put your stop at a reasonable level. It's about not just breaking a level, but how it breaks that level, and is it a good risk reward. We saw a number of earnings this week, and last week I'd said that Nike looked like an interesting setup. Earnings coming out, it's to me, it's just not worth it. I can't tell you how many gaps lower we've avoided at alpha trends in the stocks we're watching lately because we have not purchased in front of earnings. Stocks like IGT, which we had our eye on in here, we were looking to get long, but it didn't trigger, and we wouldn't have held it overnight with that anyway. Same is true for NTNX. And then right over in here, this is where we were watching for possible upside. FNSR was another one. This one we were looking at in here to get above this level, but because the earnings were coming out, we avoided it. We also, though, this week avoided GME because earnings were out, and this was a short setup. So it's not just about getting all the winners, but about avoiding the big losers. And to me, when you have an earnings catalyst, it's simply not worth the risk reward. Some people it is. I know people who held Micron overnight and participated in the upside here from those earnings. So as always, it comes down to risk management based on your personal view of the market and your risk management. The biotechs, as we know, this group was looking like maybe it had some upside potential a week and a half ago. That failed miserably as it broke down below support. We are still hovering right on this rising 50-day moving average, and the year-to-date volume weighted average price is right here as well. So I wouldn't be surprised to see us come down into this area. We've still got a declining 5-day moving average, so it's guilty till proven innocent. Now, next week, if it can get back above this level, it becomes a little bit more neutral, but it doesn't change the fact that this daily chart, we're still kind of a mess in here. So I think it's just best to leave those biotechs alone for now. Shares of Apple continue to hold up really well, and the bonds, they actually had a decent week. They did get beyond the midpoint of that range, but longer term picture, we're still in a downtrend with a declining 10, 20, 30, and 40 week moving average, or 100, 50, 100, 150, and 200-day moving averages. So if they don't scare you out, they'll often wear you out. If you're a range trader, this is your type of market. For a trend trader, though, unless you're trading on shorter term time frames and looking for that alignment, it doesn't make sense. So actually, that's going to do it for me. For now, it's been a long week. I hope everybody has a good weekend. And if you're a subscriber to Alpha Trends, don't forget we have a live webinar Monday night, as we do every 2 weeks. And that's the time to get all your questions in, and I'll talk to you next week. Thank you.